Earlier this week, we discussed the 4 most reliable and predictable players in the Mag 7. I dove into the earnings release of Microsoft, Apple, Google, and Amazon, breaking down their performance and assessing buy prices for these tech titans. Today, however, we will be looking at the other 3, the 3 businesses pushing the boundaries of AI, autonomous driving, and social connectivity. Of course, I'm referring to NVIDIA, Tesla, and Meta. These businesses have massive upside, but are they at an appropriate buy price today to capture that upside? Welcome to The Quality Investor. Check out part 1, where I provided the buy price of Microsoft, Apple, Google, and Amazon. I am quite bullish on 3 of those 4. I view the other 3 as very boom or bust, however, meaning if they execute on their growth strategies, NVIDIA, Tesla, and Meta will all provide massive value creation for shareholders. If they do not, though, we could be in for a lost decade a la Microsoft for these 3 businesses. NVIDIA has captured the market with its AI chip that is the fastest and most advanced in the world. Tesla's entire investment thesis rests on full self-driving, or FSD, and robotics. And Meta is seeking to establish itself as the leader in virtual reality. The reason they are boom and bust is that these strategies have yet to be monetized. Well, NVIDIA has certainly monetized its AI chip, but the bear case is that once another business develops a chip with the same level of performance, many are looking at AMD for that, then it will quickly become a commodity. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. If the bear case plays out for these businesses, then NVIDIA will still hum along with its GPUs and be one of many AI chips. Tesla will be just another car company, and Meta will still generate boatloads of ad revenue. Meta is making waves far beyond its social media roots. Their Q1 2025 earnings showed a robust 16% year-over-year revenue increase to $42.3 billion, driven by strong ad performance and growing user engagement across Facebook, Instagram, and Threads. Meta AI is starting to make waves, nearing 1 billion monthly active users with heavy traction on WhatsApp and Facebook. Their AI-driven ad tools are boosting conversion rates by 5%, and 30% more advertisers are leveraging Meta's AI tools. Meta also saw 349 basis points expansion in operating margin. But it's not all smooth sailing. Reality Labs posted a $4.2 billion operating loss. Meta is also facing regulatory headwinds in the EU that could dent their ad revenue. CapEx is also climbing, with an updated 2025 outlook of $64 to $72 billion to fuel AI infrastructure. This will dent free cash flow in the short term, but long term, it will set Meta up for success if their 29% ROIC track record is in any indication. Meta's family of apps delivered a 52% operating margin, showing their core business is a cash flow machine. Mark Zuckerberg highlighted 5 growth pillars: AI advertising, engaging content, business messaging, Meta AI, and AI devices like Ray-Ban Meta glasses, which tripled in sales. Meta's economic moat lies in its strong network effect. Across all of their apps, Meta boasts 3.4 billion daily users. Their massive data cache from this user base will aid their AI training significantly to better monetize this base with their AI advertising strategy. Tesla, the most volatile of the Mag 7 and with the most mercurial CEO in Elon Musk. By all traditional fundamental metrics, this business is incredibly overvalued. But their investment thesis is all about what they might do in the next year or two. Their Q1 2025 earnings was a mixed bag. Vehicle deliveries dipped due to factory upgrades for the refreshed Model Y, which impacted production for several weeks. Auto margins also took a hit from lower deliveries, and reduced regulatory credits compounded by negative brand perception in some markets. For investors that believe Tesla is just another car company, this is quite bearish and warrants a precipitous fall in share price. But Tesla is much, much more to their bull investors. Their energy storage business hit a record gross profit with megapack demand soaring. Tesla is also charging toward full autonomy with plans to launch unsupervised robotaxi rides in Austin by June 2025. That's just around the corner. This will scale to millions of autonomous vehicles by mid-2026. The Optimus humanoid robot is on track to produce thousands by year end, though supply chain issues, especially tariffs on Chinese magnets, pose challenges. On the tariff note, however, Tesla's highly regionalized supply chain, 85% USMCA compliant for US vehicles, gives them an edge over competitors. Elon Musk remains bullish, predicting Tesla could be the world's most valuable company if they nail execution. That is a huge if. But to be fully transparent, I own Tesla. It is just over 4% of my portfolio. And the main reason is I believe Elon will execute. NVIDIA is the undisputed leader in AI chips. Each earnings report going back to 2023 has been nothing short of staggering. Year-over-year revenue soared 126% from fiscal year 23 to fiscal year 24, and then 114% from fiscal year 24 to fiscal year 25. Basically, it more than doubled and then more than doubled again. This is all driven by their compute and networking segment, and specifically their data center revenue. This houses the vaunted H100 and Blackwell AI chips. CEO Jensen Huang emphasized their AI chips are in high demand, with supply constraints easing slightly, but still tight due to insatiable enterprise and cloud provider appetite. However, tariffs on certain components of their products, such as steel and aluminum for data center hardware, loom as risks. Chips, though, have been exempt from Trump's tariffs. Not only that, but the administration is set to end U.S. chip export restrictions, dubbed the AI diffusion rule. The outlook for fiscal year 2026, ending in January of 2026, again projects phenomenal growth at about 53% revenue growth. This is a slowdown, yet as the dominant market leader in AI chips, growth is expected to remain at 20% plus through 2028. The risks facing NVIDIA come mostly from competitors developing AI chips with the same or better performance. The other Mag 7 businesses are developing their own AI chips, and China has been forced to create their own proprietary technology in order to compete. Yet NVIDIA has such a huge lead, it remains to be seen which competitor, if any, can match what NVIDIA has done. So, what is the big picture? Meta is doubling down on AI to transform advertising and social engagement. Tesla continues to push boundaries of autonomy and energy storage. And NVIDIA is riding the AI wave with unmatched momentum. All three are investing heavily in the digital and AI-driven future. With Meta's 64 to 72 billion capex, Tesla's FSD and robotics bet, and NVIDIA's massive chip production ramps. The cloud and AI infrastructure boom is real. Demand is outstripping capacity across the board. Tariffs are a wild card for NVIDIA and Tesla. However, as I've discussed in previous videos, these are short-term risks. Long-term, these companies are shaping the 21st century with short-term volatility potentially offering buying opportunities. So, what is a buy price for these three businesses given their potential free cash flow outlook? Tesla closed the day at $284.82. Their earnings per share currently sits at $1.82, and they have a sky-high PE ratio of 156.5, which is actually lower than their 5 and 10-year average. But this business is completely driven by their investment thesis, which at this point isn't even bearing revenue, let alone profit. So that makes Tesla a very difficult business to put a value on. You're essentially completely guessing from the ether on what their potential growth prospects are, because we really don't know what kind of revenue bump they're going to get from full self-driving or robotics, and we don't know how far away that actually is going to be implemented. Tesla is notorious for saying something's going to happen, the deadline passes, and then it's pushed out another year. The bulls have Tesla in the thousands when it comes to a share price, with perhaps the most famous bull, Cathie Wood of ARK Invest, having them at a $2,600 share price by 2029. So my evaluation here is honestly, the bear and the base are based on what they're currently earning today and what the projected growth rates are for both their automotive and energy generation segments. And based on that, well, they're very overvalued. My bull case, I'll be honest, it's a total guess. Now, I do own Tesla, and I've said this on videos before. Tesla is my single, completely speculative investment. I think that they will achieve what they're setting out to achieve. But as a Tesla investor, you have to be very patient and deal with a lot of volatility. But if we were to take what they're currently generating in free cash flow, which is sitting at a 7.1% trailing 12 free cash flow margin, and project that out for the next 10 years, giving a bear revenue growth rate of 8%, a base revenue growth rate of 11.3%, and a bull revenue growth rate 24.3%. And we expect the operating margin to expand to 10% on the bear case and 12% on the base case. That would actually give us a free cash flow margin by year 10 of 8.2% on the bear case and 11.5% on the base case. And at that point, without any margin of safety, that's a buy price of $193.70. And with a 20% margin of safety, it's probably better to even have a 30% margin of safety on a business like Tesla. It's a buy price of $154.96, which is just slightly below what their 52-week low is at $167.41. So for Tesla, if this is even a business you're considering, understand a couple things. It's extremely volatile, which means it'll dip pretty low, sub 200. At that point, if you do truly believe in the thesis for Tesla, it's probably not a bad time to buy. But if you can't handle the volatility, or you don't believe what Elon Musk is selling, just avoid Tesla altogether. Meta closed today at $598.01. They have an earnings per share on a trailing 12 basis of $25.64, which gives them a PE ratio of 23.3, right around their 5-year average and below their 10-year average. Currently, my forward PE for them is at 23.2, slightly above their 5 and 10-year averages. Meta has turned into a cash flow machine. Love him or hate him, Mark Zuckerberg has done a very good job of leveraging their massive user base to harvest advertising revenue. My bear case revenue growth for the next 10 years for Meta is at 12%, my base case at 13%, and my bull case at 15.6%. I project their operating margin on a bear case to be at 42% by year 10, and at 44% on the base case and at 48% on the bull case. Currently, their operating margin sits at 43% on a trailing 12 basis. They have a free cash flow margin right now at 30.7% on a trailing 12 basis. My bear case free cash flow margin is at 28.6%, 33.3% for the base case, and at 40.6% for the bull case. Like I said at the outset of this video, the three businesses we're looking at today, Tesla, Meta, and NVIDIA, all have massive upside if they execute. And we can see that here in the bull case upside on the valuation summary. My bear discounted cash flow is at $772.44, $945.69 on the base case, and $1,390.76 on the bull case. They just started paying a dividend and increased that dividend by 5% for this year. We don't know what kind of dividend growth to expect from Meta over the next few years. They do generate a lot of cash, so it's reasonable to expect them to get up into the 10% realm at some point. But with that said, I do have a dividend discount on the bear case at $118.95, $188.13 on the base, and $396.81 on the bull. My exit multiple for Meta is at $461.52. That is based on comps of Google, Spotify, and Pinterest. And we can see a buy price without any margin of safety at $677.96. A forward PE of 26.3, but with a 20% margin of safety, we have a buy price of $542.36 and a forward PE of 21.1. I believe that Meta is a very good business. It has turned into a compounding machine. They have excellent ROIC, but right now at a share price of nearly $600, I think it's a little bit rich. I would like to see it come down to at least under 550 before I even consider adding Meta to my portfolio. Finally, we have NVIDIA, an absolute darling for retail investors. They closed the day at $117.37. NVIDIA has a earnings per share of $2.94 and a PE ratio of 39.9. Given the projected growth for this business, and I'll tell you what it is in a second, that is a very cheap PE. Their forward PE is at 28. As you can see, both their PE ratio and their forward PE are well below their 5 and 10-year averages. Just to give you an idea of how incredible NVIDIA's run has been the last few years, their 10-year CAGR for their share price return is at 71.9% annually. Their 5-year CAGR, 71.9% again. Their 3-year, 84.5%. And on a 1-year basis, they have a 29.8% return. Now, year to date, however, they're actually down 12.6%. My bear case 10-year growth rate for NVIDIA sits at 11.6%, on a base case at 15.2%, and a bull case at 17.5%. There's a lot of growth projected for this business. My bear case on the free cash flow margin is at 32.2%, my base case at 44.1%, and my bull case free cash flow margin is at 49.7%. For context, that would give them 10-year free cash flow growth on the base case of 14.5% per year and at 18.3% free cash flow growth on the bull case. So that gives us a bear discounted cash flow of $77.59. For the base case, we have $134.45, and on the bull case, $178.74. The exit multiple is at $137.06. I'm using comps of Broadcom, Advanced Micro Devices, Qualcomm, Texas Instruments, Analog Devices, Micron Technology, and Intel. And you can see, on the base and the bull, there's still some upside to be had for NVIDIA. But without any margin of safety, NVIDIA has a buy price of $133.32 and a forward PE of 32.1. I was torn between a 10% or a 20% margin of safety with NVIDIA. They feel reliable because they have such a massive economic moat, but you cannot count out the ever-changing landscape in the semiconductor industry. It's an incredibly competitive industry, and many of these businesses that they're competing with also have incredible talent working for them and resources to develop a chip that can compete with what NVIDIA is currently producing. So I've admitted 20% margin of safety. That means they have a buy price right now of $106.66 with a forward PE of 25.7. I'm still not 100% sold on the type of growth that is being projected for NVIDIA over the next 3 to 5 years. And we just keep waiting for this demand to sort of level off for these chips. And it's made me very uncomfortable in terms of buying into NVIDIA. Now, this business has certainly run up to some very high highs. Their 52-week high is $153.13. I think for me personally, if NVIDIA dropped down below 100, I might consider adding it to my portfolio. I have nothing against the business. I think it's an incredible business. Just not convinced that the demand is going to be there over the next 3 to 5 years to sustain the growth projections currently in place for NVIDIA. So that wraps up my look at the Magnificent 7. This was part 2. Please check out my part 1 to see my thoughts on Amazon, Microsoft, Google, and Apple. Overall, it's been a very rough year for the Mag 7, with only Microsoft and Meta currently posting positive returns year to date. The rest are down at least 10% on the year. But that said, right now I believe that Google and Amazon are the two best value plays right now in the Mag 7.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.